You know that moment when you look at your portfolio and realize you've lost money again? I'm going to reveal the real reasons why 95% of crypto traders systematically lose their money. I lost 12,000 euros in crypto before understanding something fundamental. The problem wasn't the market, but my brain and how it reacted to price movements. For months, I searched for the perfect strategy, tested dozens of indicators, spent nights analyzing charts. But the truth was simpler. I was losing because of psychological mechanisms I didn't control. You buy Bitcoin at $60,000. The price rises to $65,000 and you're happy. But when it drops back to $62,000, then $58,000, your brain fixates on those $65,000. That number becomes your mental anchor, and you stubbornly wait for that return, ignoring market signals. I experienced this with Ethereum. Bought at 3,200, rose to 3,800. I waited for that return instead of selling. Result, panic sold at $2,200, a loss of 1,000 euros that could have been a gain of 600 euros. Anchoring operates in your subconscious. You think you're analyzing the market objectively, but your brain filters all information through that anchored number. Anchoring doesn't only concern your own purchases. You can also anchor on historical prices. Bitcoin was at 69,000 in November 2021, so it will definitely return there. These external anchors are just as dangerous. The solution: note your purchase price, then forget it. Analyze the market as if you had no position. Ask yourself the question: if I had cash now, would I buy at this current price? If the answer is no, why are you keeping the position? You decide that Solana is going to explode. From that moment, your brain actively seeks all information that confirms this belief and ignores everything that contradicts it. You only watch optimistic videos, join bullish forums. You become blind to reality. I made this mistake with Cardano in 2022. I only followed bullish Twitter accounts, ignoring obvious bearish signals. Result: entered at $1.20, exited at 60 cents, 40% loss. Confirmation bias transforms trading into religion. You've chosen your crypto messiah, and now you're its blind disciple. When someone criticizes your coin, you take it personally. Social media amplifies this bias. The Twitter algorithm shows you what you want to see. You live in an information bubble calibrated to reinforce your mistakes. I've seen people hold positions down to -80%, -90%, while repeating the white paper's promises. They had built an entire narrative around their investment. It's the revolution of finance. Institutions are coming. The solution? Actively seek contrary opinions. If you're bullish, read at least 3 bearish analyses before buying. Force yourself to understand the other side. Create intentional friction against your own bias. The pain of losing 100 euros is twice as strong as the pleasure of gaining 100. This asymmetry creates paradoxical behavior. You keep your losing positions too long and sell your winning positions too early. You have a crypto at -50%. You wait for it to rise because selling would transform your virtual loss into a real loss. But a position at +15%? You sell for fear of losing that gain. I experienced this with Polygon, dropped from $1.50 to 40 cents, which I kept hoping for a miracle, and Avalanche at +20% that I sold too early while it continued to +50%. This mistake cost me more than 3,000 euros. Loss aversion is programmed in our DNA. Our ancestors who avoided losses survived better. But this ancestral wiring is unsuited to modern trading. The worst is averaging down. Your crypto is at minus 40%. Your brain tells you it's time to buy more to lower your average price. Except if the crypto continues to fall, you've just doubled your exposure to a losing position. Conversely, when you're in profit, the slightest correction terrifies you. You've waited weeks for that, plus 20%. You absolutely don't want to see it disappear. So you sell prematurely, often just before the movement accelerates. The solution? Define your stop loss and take profit before entering a position, and respect them mechanically. No emotions, no exceptions. A stop loss at minus 8%, a take profit at plus 25%. Period. The more you analyze the markets, the more you develop a sense of mastery. You believe you can predict movements because you understand patterns, indicators, volumes. The disturbing truth: the crypto market is fundamentally unpredictable in the short term. A tweet can crash the market by 15% in 10 minutes. No technical analysis protects against these black swans. After 6 months of trading, I thought I understood the market. Then a cascade of liquidations dropped my positions by 30% in 2 days. All my analysis was useless. The illusion of control is dangerous because it pushes you to take more risks. I've got this under control, you tell yourself. So you increase your exposure. You use more leverage. The best traders all have one thing in common: deep humility before the market. They know nothing with certainty. They manage probabilities, not certainties. You only control 2 things: your entry point and your exit point. Accepting this reality allows you to focus on what matters: your risk management and your discipline. The fear of missing an opportunity is probably the most costly. You see a crypto explode by 30, 40, 50%, and you have no position. This fear short-circuits your rational decision-making process. I FOMO'd on Dogecoin in April 2021. Bought at 70 cents after seeing everyone get rich, 3 days later at 15 cents. 8,000 euro lesson. FOMO is the trader's #1 enemy. FOMO is fueled by social media. You scroll Twitter, you see 10 people posting their massive gains. Your reptilian brain activates. Everyone's winning except me. I must enter now. What you don't see: the hundreds of people who lost money but remain silent. People share their gains, rarely their losses. FOMO creates a domino effect. You miss a pump, you feel stupid. To compensate, you FOMO on the next movement without analysis. You lose. Now you need to catch up even more, so you FOMO on the following movement. It's a downward spiral. The truth? If a crypto has already done plus 50% in a few days, you've missed that movement, and it's okay. There will always be other opportunities. The crypto market never sleeps. My personal rule: I never buy a crypto that has done plus 30% in 24 hours. Never. I'd rather miss 100 pumps than get trapped once buying a top. Now that you know these 5 psychological traps, the question is, what will you do with this knowledge? The only solution I've found: have a written trading plan with strict rules and follow it mechanically. Before each trade, I write my entry point, my stop loss, my take profit, and the objective reasons for the trade. If I can't write 3 objective reasons based on real data, I don't take the trade. This simple discipline allowed me to go from chronic loser to profitable trader, not through sophisticated technical analysis, but by learning to manage my psychology. If this video opened your eyes, subscribe and activate the bell. In my next video, I show you how I tested AI bots for trading for 30 days. Remember, The market owes you nothing, but your discipline can change everything.